Well, during Diwali time, I got this email from Mr. Rahul Bansal, so I had flagged it in my email system and I wanted to discuss it. So here it is. He says, Dear Rohit ji, Happy Diwali. I am enrolled in your online course. In your course, you talk about latest closing price within 25% of 52-week high, interpreted as current market price greater than or equal to 75% of 52-week high and less than or equal to 125% of 52-week high. In market Smith filter, price percentage change versus 52-week high is greater than minus 25 and less than or equal to 25. Latest closing price at least 25% above the 52-week low, interpreted as current market price greater than or equal to 25% of 52-week low. In market Smith filter, price percentage change versus 52-week low greater than or equal to 25. Is this interpretation and execution correct? Doesn't this make the second criteria redundant? Please share some light on this. Now, for those of you who are new to this channel, probably you would not have understood the question. So let me explain the question first. This might look complicated, but I will simplify it for you. So basically, he's saying that he's a student in my online course, and in my online course, or even on my YouTube channel, I have explained this filter. See this one. This is my filtered list. So here you have a technical filter called price percentage change versus 52-week high. It should be greater than or equal to minus 25. Price percentage change versus 52-week low, it should be greater than or equal to 25. Basically, what this means is if you have a 52-week low, you go up 25% from 52-week low. From that level, the current market price should be above that level. Okay. And from 52-week high, you come down 25%. The current market price should be in that 25% band, which I will show you now with the help of the chart. So let's go to Loris Labs. Okay. Now, as you know, I am a SEBI-registered research analyst. So I request you to read my standard disclaimer in the description of this video. I don't give any buy-sell recommendations or investment advice. I do not publish any research reports. All of my content is for educational purposes only. So when I show you a chart, it's all educational. Okay, so let's take an example. Let me hide this. Sorry, let me go to Loris Labs. I will close this. Yeah, have a look at this. Let's say you see this base. Let's say you see this base. This is a perfect VCP pattern as per Mark Minervini's book, How to Trade Like a Stock Market Wizard. So if you draw the base here, it looks like this. Okay. Let's say you see this, and let me draw the points for you. So that's point 1, that's point 2, 3, 4, 5. I think this probably 6, 7, 8. So point 7, that the high of this candle becomes the buy point. That is how, sorry. So high of this candle becomes the buy point. So that's how you determine your buy point. But that's not the point here. Let me remove all of this. So see, currently this is the market price, assuming this is what you see. So this is the market price. So first we need to draw that 52-week period. So let me draw a line here. I will go Alt V. So this is 17 September. So let's go to 17 September 2024. So 17 September 2024. This is 17 September. So let's draw a line here. So now you see this is the 52-week period. Now, first, we will draw the 52-week high and 52-week low. A lot of people don't understand what is 52-week high and 52-week low. Okay, the 52-week high could keep changing every single day, by the way. It's not something that is constant. If the stock is continuously going up, the 52-week high could keep changing. Now, in this case, it has not changed for a couple of months, but the high of this candle, which is 922.50, so roughly here. So I will draw a line here. That's the 52-week high. What's the 52-week low in this entire period from this yellow line to this yellow line? What's the lowest price? You see, this is the lowest price, correct? All of these are lows, but during this year, this is the lowest price, the low of this candle. So let me draw a line here. So now this is the 52-week high. This is the 52-week low. Okay, so I will remove this vertical lines. So the filter is like this. The filter is from here you come down 25%. Okay, let's come down 25%. So somewhere over here, that's 25%. Okay, let me draw a line here. So you see the current market price is within this band. From this yellow line to this yellow line, that's 25% below the 52-week high. So if the current market price is in this band, that stock will come in our list, because in our filter, we have mentioned that price percentage change versus 52-week high is minus 25%. So which means from here, you come down minus 25%. If the price is within that, that will be considered as a stock in our list. Now you take 52-week low. Now you go up 25% from here. From here, you go up 25%. So somewhere over here. Here. Yeah. So from 52-week low, you go up 25%. So the current market price is above this band. Above this band, the current market price is here, right? So you check the filter again. So percentage change versus 52-week low greater than 25%. So the current market price is above this band. Okay, that's the criteria. Now in his email, he talks about current market price greater than or equal to 75% of 52-week high. This is correct. So basically this level is 75% of 52-week high, and the current market price is above it. That's correct. And less than or equal to 125% of 52-week high, this is wrong. Okay, this is not the criteria. And by the way, this is not my criteria. This is public. This is in the public domain. It's written in Mark Minervini's book, How to Trade Like a Stock Market Wizard and Think and Trade Like a Champion. There is something called as a trend template, which Mark Minervini talks about in his book. And both of these criteria are presented by Mark Minervini many years ago. I think the book was published in 2013. Now we are in 2025. So it's been 12 years that this concept has already been disclosed to the public. It's not some rocket science. Okay, it's very simple. Basically, you want the price to be near the 52-week high. You want to buy near the high. You don't want to buy near the lows to avoid the overhead supply. Notice that this distance is 25%, this distance is 25%. How come this distance is bigger than this distance? Because this is not a logarithmic chart. This is an arithmetic chart. This is a normal chart. You make it logarithmic, then you see that this distance and this distance looks the same. Okay, that's the difference between logarithmic and arithmetic chart. We'll not get into that. It's not important. Basically, from 52-week low, you go up 25%. The price should be above this yellow line. From here, you go down 25%. The price should be in this band. Now, sometimes what happens is the distance between 52-week high and 52-week low could be small, such that could be less than 25% such that this value goes here somewhere. Okay. So in the email, he's asking, is this interpretation and execution correct? The answer to this question is no, because this 125% is wrong. This is fine. We already spoke about the 52-week low. Doesn't this make the second criteria redundant? So what he's saying is that if the price is within this band, why do we need the, obviously the price is above the 52-week high. Obviously it is about 25% above the 52-week high, 52-week low, correct? So if this criteria is true, what is the need for this criteria? Because sometimes the distance between 52-week high and low could be so small, it could be like 25%, less than 25%. So this line would go here somewhere, and this line would be below that line, correct? So basically, I am saying that if the distance between 52-week high and low is 25% or less, that stock doesn't meet the second criteria, this particular criteria. So we want that the stock has already traveled a great distance. So if you see here, this is the 52-week high, 52-week low. What we want is from here, the stock should travel good distance above. It should cross that 25% level. That is when the moving averages will get aligned. That is when the stock will go into a confirmed stage 2 uptrend. And here, when it reaches near the 52-week high, the overhead supply is less. The retail supply starts gradually slowing down, or retail supply begins to extinguish. And then you get a sudden spike. Okay. So that would be my answer. Basically, from 52-week high, come down 25%. From 52-week low, come up 25%. The price should be above this yellow line. The price should be inside this band. Both the criteria should be satisfied. Otherwise, we don't want that trade. I don't know why the balloons came. I did not click anything here. Anyways, maybe Zoom has some artificial intelligence working behind it. I have no idea what is happening in the world. But anyways, that would be my explanation. And another thing, don't forget to download this Orange Trading Framework. The link to download this is in the description box of every single video that I have published. This is the framework which is like the essence of what William O'Neill, Mark Minervini, David Ryan, Patrick Walker talk about, Mark Ritchie. This is the essence of what it is all about. You have to do liquidity analysis, comparative analysis, technical, fundamental, and market analysis. A lot of people spend their time on technical and fundamental, but comparative analysis is very important. What is the point in buying a fundamentally strong company which has a relative strength of only 25 or 26? Chances are you will lose money in that stock, even if the company is fundamentally strong. And the basic question that William O'Neill was asking back in the late 60s or early 70s is that if a company is fundamentally strong, why is the relative strength of the stock 25? Why is it that 75% of the stocks in the stock market are outperforming this fundamentally strong company? So you cannot ignore the comparative analysis. Relative strength is a part of comparative analysis. Remember that. Download this, print this, laminate this, stick it in front of you wherever your wall is so that you can see this, so that you don't forget whenever you're looking at a stock, don't forget to do all this kind of analysis. Even if it's a swing trade where we don't give much weightage to the fundamentals, even if it's a swing trade, if you have, let's say, 3 prospects for a swing trade, the one that is fundamentally stronger, we have to give more priority to that. So the link to this is in the description box of this video. I would like to thank Mr. Rahul Bansal for raising this question so that I could address it. The second criteria is not redundant, it is important. Otherwise, why would have Mark Minervini written it in his book? He would have thought of the criteria, right? If the 52-week high criteria is satisfied, why do we need to look into 52-week low? Well, because there could be an entire 1 year period where the stock has just languished within a 20% range. We don't want that kind of a stock. We want a stock that has gone up, that has traveled a great distance in the past 1 year. Even if it's gone up 100%, that is fine. Okay, it doesn't mean that it's extended. It means that it is in a confirmed stage 2 uptrend. That is what I wanted to discuss in this video. Please keep sending me your questions. When you download this, you will automatically come onto my email newsletter list. And I keep sending uh, emails. Some are educational emails, some are promotional emails where I invite you to enroll into my video course. But I will be sending educational emails as well, so I can add value from my email list to my email list subscribers as well. So I will see you in the next video. Thank you so much.